There's a pattern running through the economy that almost nobody ever notices. You won't find it in your school textbooks. Financial advisors don't sit you down and explain it. The mainstream media pretends it doesn't exist. And yet this pattern has quietly stood in the background of history, flashing warning signs before every major economic disaster of the last 2 centuries. It signaled the crash of 1873. It lined up with the collapse of 1929. It was there before 2008. And now that same pattern is pointing like a laser at a very specific point in time. Not somewhere in the future. Not sometime this decade. A narrow window centered around 2026. The math behind it is not vague. The historical record is not soft or fuzzy. Once you understand what you're really looking at, you realize this isn't about guessing tops or bottoms. It's about seeing the storm forming long before the average person even feels the wind. This isn't about conspiracy theories. It isn't about doom for the sake of doom. It's about cycles. Economic cycles that repeat as reliably as the seasons. Just as winter always comes after autumn and spring always follows winter, periods of economic boom are eventually followed by breakdown and reset. Humans forget this. History doesn't. The particular cycle we're talking about today was studied and mapped almost a century ago by a Russian economist named Nikolai Kondratiev. In the 1920s, when most economists were focused on short-term fluctuations, he dug into decades of deep data, prices, wages, interest rates, industrial output, commodity trends, stretching all the way back into the 1700s. And what he found was not random chaos. He found long waves, a repeating pattern running roughly 40 to 60 years, made up of 4 distinct phases, like economic seasons: spring, summer, autumn, winter, growth, prosperity, stagnation, collapse, over and over again. Kondratiev didn't just throw this out as a philosophical idea. He painstakingly documented it. He measured it. He overlaid the waves across events in Britain, Europe, and the United States. He showed that these long cycles weren't just noise. They were driven by major forces: the birth and spread of new technologies, the buildup of debt, and the eventual destruction of outdated structures that can no longer survive. His research was so accurate and so uncomfortable that it became dangerous. The Soviet regime of Stalin didn't want to hear that economic winters were inevitable, that no political ideology could abolish cycles. In 1930, Kondratiev was arrested. In 1938, he died in a labor camp. The man was silenced. His cycle wasn't. It lived on, studied and refined by others, and time after time it lined up with reality. Each new winter wave showed up with the same ugly characteristics: collapsing asset prices, cascading failures, and a brutal clearing out of excess debt. To understand where we are now, you need to understand how a Kondratiev long wave unfolds. It begins with spring. Spring is the recovery phase after a major crisis. Think of a landscape after a wildfire, charred but ready for new growth. The previous winter has already wiped out the worst excesses. Bad debts were destroyed. Weak businesses died. Only the stronger or smarter players survived. In the spring phase, interest rates are low, but not yet distorted. Prices are relatively stable. Sentiment slowly moves from fear to cautious optimism. After World War II, the 1950s were a textbook spring. America rebuilt. Europe rebuilt. New highways, factories, and suburbs sprang up. Television became normal. Cars spread. Optimism returned. But it was not manic. It was grounded in real production and real rebuilding. Then comes summer. Summer is the boom. The new technologies born in spring: cars, electronics, infrastructure, communications, mature and spread everywhere. Jobs are plentiful. Wages rise. Most people feel like the future is secure. Demand runs so hot that inflation starts creeping up. Stocks grind higher. Businesses expand aggressively. Confidence turns into pride. The 1960s fit this phase almost perfectly. The space race. Manufacturing at full strength. Rising wages. A sense that American prosperity was permanent. Beneath that sunshine, though, something else was happening. Debt was starting to build. Inflation was slowly picking up. The seeds of the next phase were quietly being planted. Then autumn arrives. Autumn is the plateau. Growth slows. But nobody really wants to admit it. The boom doesn't feel as strong, but people are still acting as if summer will last forever. Inflation becomes a real problem. Central banks step in with higher interest rates, which cool the economy but don't fix the underlying imbalances. Asset prices start drifting away from their fundamental values as more people chase speculation and financial engineering instead of productive work. You saw this in the 1970s and early 1980s. Stagflation, high inflation combined with weak growth, oil shocks, rising unemployment, politicians and central bankers trying one policy after another. The feeling that something was off but no clear diagnosis. The system was heavy, sluggish, overloaded with promises. Autumn is not the collapse, it's the setup. Then comes winter. Winter is when the bill arrives. The debts built up through spring, summer, and autumn finally become too big. They cannot be rolled over forever. They cannot be hidden with clever accounting or fresh borrowing. Bubbles burst. Banks fail. Unemployment spikes. The stock market crashes and doesn't bounce back right away. Businesses that were kept alive by cheap credit die quickly. Once winter is underway, all the fake stability of autumn dissolves. The early 1930s were pure winter, the Great Depression. Thousands of banks gone. A quarter of the workforce without jobs. The stock market losing nearly 90% from its peak. It took until the mid-1950s for U.S. stocks to truly regain their 1929 levels. That's what a Kondratiev winter looks like when it's allowed to fully express itself. But remember, winter is not the end of the story. It's the reset. When winter has done its damage, a new spring eventually starts. New industries rise. New technologies that were immature before finally become dominant. Old debt has been burned away. The cycle begins again. If you look at the modern era through this lens, it lines up almost too neatly. Spring after the Depression and World War II in the 1950s. Summer in the 1960s. Autumn in the 1970s and early 1980s. A new wave of innovation and deregulation rolling through the 1980s and 1990s. And then, something strange happened. By the underlying long-wave logic, 2008 should have been a full-blown Kondratiev winter, a devastating cleansing that reset the system much more brutally than it actually did. The housing bubble had blown up. Major banks were on the brink. Financial markets were cracking. We saw fear, but we did not see a complete structural reset. Why? Because governments and central banks slammed their hands down on the cycle. They bailed out failing institutions. They cut interest rates all the way to zero. They launched quantitative easing and printed trillions. They did everything in their power to stop winter from running its natural course. And in a way, they succeeded. They prevented total collapse. But cycles don't simply disappear because policymakers dislike them. Winter wasn't canceled. It was postponed. Instead of allowing the system to clear its dead wood, they layered new debt on top of the old. They kept zombie companies alive. They encouraged speculation with artificially cheap money. They blew air not into one bubble, but into almost everything. That's why we now live inside what many call an everything bubble. Not just housing, not just tech stocks, not just one region. Almost every asset class, equities, bonds, real estate, even collectibles and fine art has been pushed to historically extreme valuations. This is where the story begins to intersect with another set of cycles overlaying the Kondratiev wave. The original long wave from peak to peak is usually 50 to 60 years. The last major peak where things shift from late autumn into winter was in the late 1960s and early 1970s. If you add 50 to 60 years to that, you get a window roughly between 2020. We're in that window right now. But that's just the first layer. There's also what some analysts refer to as the debt supercycle, a longer arc where debt builds up over multiple generations until the entire system reaches saturation. Historically, this has run about 70 to 80 years. The last time the world truly hit that wall of unsustainable debt was in the 1930s during the Great Depression and the aftermath. Add 70 to 80 years to 1930 to 1940, and you land in the 2020 timeframe, right when global debt hit record levels, and central banks had to resort to extraordinary measures just to keep the game going. Then there's the generational cycle, the reality that every 80 to 90 years society forgets. The people who lived through the big trauma are gone. Their direct experience dies with them, and when memory fades, the same mistakes are made again. The last great generational crisis was the 1929 to 33 period. Roughly 80 to 90 years from then puts you right around 2010-2023. The people who truly remembered what a collapsing financial system feels like are gone. A generation has grown up believing that central banks can always fix things and that markets always come back quickly. So now you have three arcs all overlapping. The Kondratiev long wave, the debt supercycle, the generational forgetting cycle. Individually, each one suggests rising risk. Together, they point like arrows at a narrow band of time, 2022 to 2027. And when you examine the more granular timing tools, subcycles and leading indicators, something sharp stands out in the middle of that band. Not as a mystical date, but as a high probability zone of maximum stress. This isn't guesswork. Within these cycles, certain measurable signals give you more precise timing. One of the most powerful is the yield curve, the relationship between short-term and long-term interest rates. Under normal conditions, long-term rates are higher because lending money for a longer time carries more risk. When short-term rates rise above long-term rates, the curve inverts. Historically, that inversion has preceded every U.S. recession since the 1950s. Not most, not some, all. The yield curve inverted in 2022 and stayed inverted for an unusually long time. When it finally turned back to normal, uninverted in 2024, the clock effectively started. Historically, the recession doesn't show up during the inversion. It arrives 6 to 18 months after the curve uninverts. That points to a window between roughly early 2025 and early 2026 for the downturn to bite hard. Then you look at corporate credit spreads, the difference in borrowing costs between safe companies and riskier ones. When spreads are narrow, investors are relaxed. When spreads widen, fear is entering the system. Spreads have already started to widen from the tight, complacent levels of the past decade, with the move beginning in late 2023 and speeding up into 2024. Historically, major crises tend to follow that widening by about 1 to 2 years. Again, that lands you in 2025-2026. Then there's the velocity of money, how fast money changes hands in the economy. Velocity tends to peak when growth is hot and confidence is high. It begins to fall when people start hoarding cash and pulling back. The current velocity peaked around 2022 and has been trending downward. Historically, big recessions tend to begin 2 to 3 years after money velocity peaks. That points to 2024-2025 as the visible onset, with the full impact rolling into 2026. Consumer debt is flashing its own warnings. During boom periods, households borrow more, credit card balances grow, auto loans grow, mortgages expand. Eventually, these debt service costs reach a point where they eat too much of disposable income. Historically, when household debt payments exceed a certain percentage of income, a crisis follows within about a year and a half. That threshold has already been crossed. That timeline points toward late 2025 and into 2026. And perhaps the sharpest structural trigger sits in commercial real estate. Trillions in loans on office buildings, shopping centers, and various properties must be refinanced between 2024 and 2027. These loans were made when interest rates hovered near zero. Now they have to be refinanced at much higher rates. Many of these properties simply do not generate enough income to cover the new debt costs. As that refinancing wave crests, especially around 2025 and 2026, the probability of default spikes. When commercial properties fail, the pain doesn't stay there. It flows into regional banks, which hold a lot of this debt. Regional banks under pressure become fragile. If enough of them crack, confidence collapses, credit markets tighten, lending dries up, and when credit disappears, even healthy businesses choke. The steepest refinancing wall sits right in early to mid-2026. That is a structural, calendar-based stress point, not an opinion. Layer all of that onto the everything bubble created after 2008. Normally, a bubble concentrates in one area like tech stocks in 2000 or real estate in 2008. That means there are safe havens when it bursts. Bonds might be safe, cash might be safe. This time is different because stimulus and zero rates inflated almost every asset class at once. Equities, bonds, real estate, speculative tech, even some alternatives all climb together, held up by oceans of cheap money. When that kind of broad inflation unwinds, there are fewer places to hide. Global debt to GDP has pushed to levels higher than even the worst moments of the Great Depression. Governments are drowning in obligations. Corporate debt is bloated, with many zombie firms surviving only because they can roll their loans endlessly at low rates. Households carry record burdens. And now, after a decade of nearly free money, interest rates were forced higher in a desperate attempt to fight inflation. That puts central banks in a trap. If they keep rates high, they crush over-leveraged borrowers and trigger default waves, winter in its pure form. If they push rates back down and restart large-scale money printing, they risk destroying their currencies through sustained inflation. Neither path is painless. One path is sharp pain now. The other is deeper pain later. Politically and psychologically, policymakers almost always choose later. They will cut rates, restart stimulus, and act like saviors. Markets will likely rally on this. Investors will breathe a sigh of relief and tell themselves the worst was avoided. That relief, historically, has often been the last big upswing before the true winter storm. If the cycle holds, the path looks something like this. First, a crack, a visible break, maybe a big bank failure, a sovereign default, a sudden crash in a particular market like commercial real estate, or a chain of corporate blow-ups. This doesn't bring down the entire system immediately, but it signals that the dam is no longer sound. This kind of event typically shows up 6 to 12 months before the full crisis. That points to late 2025 or the very beginning of 2026. Then contagion. The fear spreads. If one bank can fall, maybe others can too. If one country can default, maybe its neighbors are next. Credit begins to freeze. People and institutions stop trusting each other's balance sheets. Transactions slow or stall. Funding costs jump. This phase usually lasts a few intense months. Think spring to early summer 2026. Then intervention. The authorities step in aggressively. Rate cuts, emergency lending programs, stimulus packages, bailouts, new acronyms, new facilities. It looks decisive. Markets stabilize for a while. On the surface, things appear to improve. But the deeper structural damage isn't fixed, it's just hidden. Historically, this rescue phase tends to last several months. That's your mid to late 2026 period. Then the secondary collapse. Confidence in the rescues erodes. People realize that money printing and cheap loans can't magically restore solvency or productivity. Markets that bounced start falling again harder. Unemployment accelerates. Government revenues shrink just as social costs rise. Social mood turns dark. Anger, blame, and unrest grow. This is the heart of winter, and it tends to last 1 to 3 brutal years. In our rough map, that sits in late 2026 through 2028. Finally, stabilization and reset. After enough defaults, bankruptcies, restructurings, and write-downs, after leverage has been squeezed out, after the weakest entities have failed, a foundation for a new spring appears. Asset prices are no longer fantasy. They are grounded in reality. New technologies suppressed during crisis begin to look viable again. Capital held by cautious survivors can be deployed at incredible values. That's the early 2030s spring. The key point in all of this, understanding the cycle, is not about predicting every tick of the stock market. It's about recognizing the phase we're in and acting accordingly. People who grasp the essence of a Kondratiev winter don't sit around trying to call the exact top. They accept that winter is approaching and gradually prepare. They build cash, reduce unnecessary risk, get out from under fragile debt structures, and mentally rehearse what a serious downturn feels like, so they're not paralyzed by fear when it arrives. History shows that those who prepare for winter, rather than pretending it will never come, are the ones who make life-changing moves during the worst moments. Investors who had cash in 1932 to 1933 could buy stocks and land for cents on the dollar. Those who bought foreclosed properties in 2009-2010, when everyone else was terrified, made fortunes in the following decade. Those opportunities only exist for people who survive the winter with capital intact and a clear head. The hardest part isn't financial, it's psychological. In the late autumn phase where we are now, everyone around you seems to be doing fine. Some are still bragging about gains. Financial media celebrates resilient markets. Experts insist that central banks are in control. The pressure to keep playing the game is intense. Sitting on extra cash feels like cowardice. Reducing risk feels like you're missing out. But that's exactly what autumn always feels like before winter. Preparation doesn't mean going to extremes. It means shifting gradually and intelligently. Taking some chips off the table, quarter after quarter. Reducing unnecessary leverage. Paying down the kind of debt that could force you into desperate decisions later. Diversifying not just across paper assets, but into things that hold value when systems shake. Hard assets, essential businesses, productive land, stores of value that are not someone else's liability. No cycle is a guarantee. These patterns don't come with 100% certainty, but they are not random either. They are rooted in human behavior, in how we respond to fear and greed, in how we overextend in good times and overreact in bad times, in the mathematical reality that debt cannot grow faster than income forever. What makes the 2026 window so important is not one indicator but the alignment of many. Long waves pointing to this decade. Debt supercycles reaching exhaustion. generational forgetting at its peak, inversions and reversals in the yield curve, widening credit spreads, falling money velocity, record consumer and government debt, a historic refinancing cliff in commercial real estate, an everything bubble inflated by years of extreme monetary policy, all converging. A lot of people will look back later and say, no one saw it coming. They always do. They said that after 1929. They said it after 2008. But in both cases, there were people who did see it, people who studied the cycles, listened to the signals, and acted before the crowd. If you're hearing this while there's still time to reposition, you're already ahead of most. You don't need to predict the exact week or month of the crash. You just need to respect the pattern. The cycle doesn't care whether we believe in it. It keeps turning. Winter is on the horizon. The question is not whether it arrives. The question is what you'll look like on the other side, broken and blindsided, or prepared and ready for the spring that always follows.